Hey friends, hope you all are doing great and taking great care of yourselves. In this video, we are going to discuss the tax treatment in case of virtual digital assets. There are a lot of amendments made by Finance Act 2022 to incorporate the tax treatment in case of income arising from virtual digital assets. So many issues are there that needs to be discussed in this video, such as in case I have income arising from virtual digital assets, will I be in a position to take the advantage of basic exemption limit? Will there be a rebate available under section 87A? Under which head the income would be taxable? Would it be taxable as income from profits and gains of business or profession, or it would be taxable under the head capital gain? Under, or rather I would say, whether benefit of indexation would be available if I am taxing it under the head capital gain. When section 115 BBH categorically provides the rate at 30%, will it have any difference whether I would tax it under the head PGBP or IFOS, or let's say under the head capital gain? There are so many issues which we are going to discuss. We are also going to discuss what would be a situation that in case of a loss that I already had in the last year. Now you are prohibiting from the current year. What about the loss which I already incurred in the last year? Can I claim the same as set off? And we will also deal with one practical example covering various situations. So all these things we are going to discuss in this particular video. I have received suggestions from few of the friends that I should rather come up with a PPT which would give a better clarity. So I have attempted to prepare a PPT and try to explain these provisions through PPT. I am not good at preparing PPT. I feel more comfortable when I explain the provisions directly from the act, but then this time I have tried to prepare a PPT, and let's try with those provisions. So now I am sharing my screen with you. I hope this screen is visible. So we are trying to deal with tax on crypto virtual assets. Now, introduction by Finance Act 2022. What did Finance Act 2022 did? A new flat rate scheme for taxation of virtual digital assets has been introduced by the Finance Act 2022. Section 2 bracket 47A defines what is virtual digital assets. 115BH provides that the method of computation and the tax rate. Section 194 as deals with the deduction of tax at source. I would prepare a separate video on section 194S, and addition of VDA to the definition of property for taxation of deemed income under section 56(2) clause 10. So all these things we are going to discuss in this particular video. Definition of VDA is as per section 2 clause 47A. I am not going to put the entire definition of VDA. We can say that VDA, the way it is defined under section 2 clause 47A, it covers information or code or a number or a token generated through cryptographic means, non-fungible token, and any other digital asset. So all those things are covered in the definition of VDA. Now let's go to section 115 BBH and let's put this section in a simple words. First of all, please note that section 115 BBH falls in chapter 12 of Income Tax Act. Chapter 12 provides sections 1110 to section 115 BBI, which provides for a special rate or specific rate of tax with respect to certain income. Now, before I actually start with 115 BBH, or we start interpreting 115 BBH and we look into the various issues involved, let us have a quick review of certain basic provisions which would definitely be helpful to me in explaining some of the provisions. So let us first of all deal with section 2 clause 45, which defines total income. Total income means income referred to in section 5 computed in the manner laid down in the act. So before I go to the computation part, I need to see that whether this income falls in the scope of section 5 or not. Section 5 says that if you are a resident, you would be globally taxed, meaning thereby if you are a resident, you are going to be taxed with reference to income accruing or arising in India, or income deemed to accrue or arise in India. They further say that you are going to be taxed with respect to income received in India or deemed to be received in India. You are also going to be taxed with respect to income accruing or arising outside India, meaning thereby if you are a resident, you are going to be globally taxed. If you are a non-resident, you are going to be taxed only with respect to income accruing or arising in India or deemed to accrue or arise in India, or income received in India or deemed to be received in India. But if you are resident but not ordinary resident, you are going to be taxed with reference to or with respect to the income accruing or arising in India, deemed to accrue or arise in India, received in India, deemed to be received in India, as well as income accruing or arising outside India from the business which is controlled from India or from a profession which has been set up in India. Now, why do I really discuss these provisions at this moment? I will let you know in a little while. But then this is the basics, meaning thereby before I go to computation, I need to first have a clarity or as regards residential status of the particular person. So I will come to this provisions, this discussion in a little while from now. So now from this it is clear that residential status is of a great importance to decide under which to decide whether this particular income is going to be taxed or not. So once it is decided that the income falls in the basket of section 5, the next step would be to remove the exempt income from the basket. If the income is falling in the basket by virtue of section 5, as just we discussed, then remove the exempt income as referred to in section 10, 11, 12, etc. So remove that particular income, and now whatever income is left out, that particular income as per section 40 needs to be classified under the 5 heads of income. Salary 15 to 17, house property 22 to 27, PGBP section 28 to 44 DB, capital gain section 45 to section 55A, and income from other source section 56 to section 59. Now all this particular income which are given in 5 weights are going to be taxed at the rate given in part 3 of first schedule to Finance Act. For individual, they are slab rates, right? For a partnership firm, it is going to be 30% and so on. Now, let's say for a company, it is 25% if the turnover is less than 400 crores, more than 30% if the turnover is more than 400 crores. If you, right? And not only the income is going to be taxed as per the part 3 of the first schedule, there are special rates given under chapter 12, that is section 1110 to 115 BBI. So under this head, special rates given and income referred to in this sections are going to be taxed as per this special rates. They are not going to be taxed as per the rates which are given in part 3 of first schedule to the Finance Act. So let's take an example. Section 111A. Section 111A talks about short-term capital gain arising on account of a transfer of an equity shares or units of equity-oriented mutual fund on the floor of the stock exchange where STT is paid. Then the section categorically provides it to be 15%. But let's say there is a short-term capital gain arising on account of a transfer of land. Then we don't have a particular specific section under chapter 12. So it is going to be taxed as per the slab rates. Meaning thereby my section 115 BBH, it is falling in this chapter 12. Since this section is falling in chapter 12, this income is going to be taxed as per this specified rates. Now please also note that chapter 12 follows chapter 4. So unless the income is classified into any of the heads, this chapter 12 will not come. That is the reason it is necessary that income is required to be classified under a particular head. Anyway, we will discuss all those issues in a little while from now and in this particular video. Now, with this clarity, let us deal with section 115 BBH and the key takeaways. There should be a transfer of any VDA, that is virtual digital assets, whether held as capital asset or not. Now, this line is of great importance. They say that you can enter in the chapter of, or rather you can enter in the section 115 BBH or 115 BBH can be brought to play if there is a transfer of VDA. Unless there is a transfer of VDA or unless income is arising on account of transfer of VDA. So if the income is arising on account of a reason other than transfer of a VDA, in that particular case, 115 BBH will not be applicable. Now, can we really have an income arising on account of a reason other than transfer of VDA? I will deal with that. We have slide on that. We will deal with that case as well. And in that case, 115 BBH will not be applicable. Now, also look at this language once again. Or that there should be a transfer of any VDA whether held as capital asset or not. So either it is held as capital asset or it is not held as capital asset, meaning it is held as an inventory. Irrespective of the fact, if there is a transfer, now the definition of transfer we have in section 2 bracket clause 47. So it falls in the definition of transfer, then this particular VDA, if whatever income arising on account of transfer of VDA, that will be covered over here, and that transfer of VDA should result in income, of course, and in that particular case, the tax on the income from the transfer of such VDA shall be calculated at the rate of 30%. Of course, there is a restriction on deductions, there is a restriction on set up and carry forward. I will come to all those issues. In a later while. But then as of now, let us understand the rate of tax is 30%, but only in a case when income arising on account of transfer of the VDA. If income is not arising on account of transfer of VDA, 115 BBH will not be applicable and the general other provisions will be applicable. Now, chargeability of the VDA. If we go back to the slide which talks about taxation under section 115 BBH, then we'll find that it just provides for the tax rate and manner in which income from the transfer of the VDA should be computed. It does not provide for the chargeability of income to tax. So as we discussed, just section 4, section 5, section 9, 14, so in accordance with those particular sections, the chargeability should be there. Now, before I go on to the chargeability, now the reference of the discussion just we had, residential status. Now, let us take a situation that if VDA are situated outside India, so far as a resident is concerned, irrespective of the location where the VDA are situated, irrespective of the place, location of the situs of the VDA, this income is going to be taxed because resident is going to be globally taxable. That is what we have just seen. But what if you are a non-resident? In that particular case, how the VDA is going to be taxed? We need to know the situs of the VDA. And what is going to be the situs of the VDA? Currently, you are aware that there is no express provision given with respect to the situs of the VDA. So, let us take a situation that if there is a transfer of VDA outside India, money is received outside India, and the assessee is a non-resident, then it may not be brought to tax. Of course, in case of a non-resident, we know that section 9 deals with income which is deemed to accrue or arise in India. However, this taxability will be subject to double taxation avoidance agreement which government of India is empowered to enter with the other country. What I try to convey through this point here is, so far as you are a resident assessee, there is absolutely no problem. Because irrespective of the situs, you are going to be globally taxable. There is no problem. But if you are a non-resident, then the situs of VDA would be of great importance. Right? Now, there are no express provision as on date with respect to situs of VDA. And that's why we need to go to certain judicial interpretation. Right? So, in that case, please note that we have to go to a decision of Union of CUB Private Limited versus Union of India 2016 71 taxman.com. In that case, Honorable Delhi High Court has held that the situs of the owner of the intangible asset would be the closest approximation of the situs of an intangible asset. I repeat, the situs of the owner of an intangible asset would be the closest approximation of the situs of an intangible asset. Right? So, this is an internationally accepted rule unless it is altered by local legislation, and there is no such alteration in the Indian context. Correct? So, if the situs of the owner is, let's say, outside India, then obviously it would be presumed that the virtual digital assets are also outside India. Even we have a judgment in the case of Vodafone as well as in the case of Azadi Bachao Andolan, where they have held that if the owner of the property is not resident in India and the property is transferred outside India, then the income arising on transfer cannot be taxed in India. Of course, explanation 5 to section 911 offers certain situation when it can be taxed, but then it has applicability in a limited extent. It has applicability in case of interest and shares. It does not really deal with the VDA. So some clarification, some amendments are required in those particular cases. So the entire discussion with respect to, if I can talk about the situs, is relevant so far as taxation of non-resident is concerned. And if the situs of the rules on situs of the VDA are not available, then we can apply the Delhi High Court ruling, which provides that the situs of the owner of an intangible asset would be the closest approximation of the situs of that particular intangible assets. And we may conclude that if the non-resident is situated outside India, if the non-resident is transferring a VDA outside India, payment is received outside India, in that particular case, a view may be taken that the income arising from transfer of that VDA may not be taxed in India. Now, this leads towards, now the first issue gets over, and now we are entering into the other issue, that is under which head income should be chargeable to tax. We just discussed that the total income of an assessee is computed under the 5 heads of income, and the provisions of which are contained in chapter 4. So section 14, which talks about taxability under 5 heads, salary, house property, PGBP, capital gain, income from other source, these all discussions are given in chapter 4 of the Income Tax Act. The income so computed is taxed at normal rates specified in part 3 of first schedule to the Finance Act, and special rates specified in chapter 12, which includes section 1110 to section 115 BBI, which we just discussed. So section 115 BBH falls in the chapter 12. So unless this particular unless the income falls in chapter 4, unless the classification is done, the chapter 12 will have no applicability. So basically, if I can say now, if we can go back to the 115 BBH, where we have just put the bullet points, they say that there should be a transfer of any VDA, whether held as capital asset or not, meaning thereby this line impliedly conveys that it can be a capital asset or it can be an inventory. If it is held as an inventory, certainly the income arising from transfer of VDA would be taxed under the head profits and gains of business and profession. If it is held as capital asset, now can VDA be treated as capital asset? Can it be considered as capital asset? That is the precise question. If we go to the definition of capital asset, which is given in section 2 clause 47, it means that property of any kind, or rather it provides the property of any kind held by an assessee. So property of any kind, it is such a wide phrase. It includes tangible, intangible, it includes tangible assets, intangible assets, movable assets, immovable assets, corporeal assets, incorporeal assets, right? So certainly virtual digital asset is a property of, falls in the phrase property of any kind. So certainly it is a capital asset. So if I hold this virtual digital asset as my capital asset, I am investing into virtual digital asset not with an intention to trade, or if it is not an adventure in the nature of trade, I can be taxed under the head capital gain. I can treat them as a capital asset, and the income arising from the transfer of those virtual digital asset will be taxable to me as capital gain. If they are held as inventory, or I have done a kind of an adventure, or then it would be, if it is an adventure in the nature of trade, I'm sorry, in that particular case it would be a business income. Of course, section 56 subsection 1 would also be applicable. If it is section 56 subsection 1 provides that it should be an income, it should not be an exempted one, and it is not taxed under any other heads. If that is the case, then it would be taxed under 56 1. So if I say I have not done an adventure in the nature of trade, or it is not falling in the chapter of capital gain because I have not hold it as a capital asset as well, then your income would be covered under income from other source. Now you would ask a question that what difference will it really make? I go to IFOS, I go to PGBP, or I go to capital gain. Will it make any difference? Will it really make any difference? The answer is yes. Though the tax rate is same 30%, but it will definitely have a relevance. Why? Number one, section 234C, it provides that there will be an interest if there is an underestimation of income. So if there is a failure on the payment of advance tax, and because of the underestimation of income, in that particular case, interest under section 234C would be levied. But if the failure is on account of capital gain, then it won't. So the first difference. And second, in case of, we can say, surcharge, once again there are certain relaxations available. So keeping in mind this two things, the head under which it gets classified will have a relevance. Of course, one can come up with a question ki क्या advantage of indexation would be available if the virtual digital assets are held as capital asset. Please note that here the period of holding would be 36 months and not 12 or 24 months. So if they are held for a period of more than 36 months, then can they be treated as a long-term capital asset? Yes. And if they can be treated as long-term capital asset, can the advantage of indexation would be available? Now please note that section 115 BBH provides that it has overruling effect over any other provisions of the Income Tax Act, and they say that no deduction in respect of any expenditure other than cost of acquisition, if any, or allowance or set off or any loss shall be allowed. So it has overriding effect over any other provision. So even section 48 gets overruled and no benefit would be available. So benefit of indexation will not be available. The question that here I have for you is, benefit of indexation will not be available for financial year 22, 23 and onwards. What about prior years? Will there be a benefit of indexation available? So we will discuss that in a little while from now. So now with this clarity, let us go ahead. So chargeability of VDA we have dealt with, head of income we have covered. Now deal with the first situation, lending of VDA. We are aware that there are certain exchanges which allow investors to lend their holding of cryptocurrencies to earn interest. Now this interest income which is earned, it is not on account of transfer of VDA. So section 115 BBH will not be applicable. Of course it is an income and it would be chargeable to tax, but it would be chargeable to tax as per the normal provisions and not as per section 115 BBH. So it will not attract a rate of 30%. So now please appreciate and understand the point. Now this leads towards various issues and it would have a relevance. Number A, as I mentioned, that okay, I come to those issues as I mentioned that advantage of basic exemption limit of 115 BBH, rebate under section 80A. We are going to discuss those in a little while. So the first thing, let us understand this as a first exception, which says that I am having an income from virtual digital assets. This income is arising from virtual digital assets and it is not on account of transfer. So 115 BBH will have no applicability in this particular case, right? Now let us also deal with section 56(2) clause 10. If I am receiving any virtual digital asset by virtue of a gift, if it is being received as a capital asset, sorry, if it is received as a gift, virtual digital asset, I am receiving that virtual digital asset as a gift. If it is received by me from a related party or on account of marriage, right, in that particular case there is no problem, it won't be taxable to me. But otherwise, if otherwise is the case, if I have received that virtual digital asset not from a related party, in that particular case it would be taxable to me under section 56(2) clause 10. So let's say I have received this by virtue of a gift, not from a related party, from an unrelated party. Now gift is not a transfer as per section 47. Now I have received this virtual digital asset as a gift from an unrelated party. So section 56(2)(10) would be applicable. If the value of benefit is more than 50,000 rupees, certainly it would be applicable and then it would be going to be taxed to me. But then it has come from an unrelated party. If it has come from it has come by way of a gift, and gift is not a transfer. Since gift is not a transfer, the income is not arising to me on account of section 115 BBH. So it will not have applicability. So it will not be taxed at the rate of 30%. It will be taxed as per the normal provisions, meaning thereby it will be taxed as per the slab rates. If I talk about individual HUF, AOP, BOI in that particular case, right? So it will be taxed as per the slab rates. It will not be taxed as per the 30%. But let's say when I transfer Or let's say when I transfer that particular VDA, what would be a situation in those cases? If I transfer that particular VDA, yes, it would be now the income arising to me, it would be taxable to me as per section 115 BBH, because now it is a transfer. The question now would come here is, when I'm transferring that virtual digital asset which I have received as a gift, what would be the cost of acquisition? Now let's say if I have received from a related party, in that particular case, or let's say I received on account of on occasion of my marriage, I received by way of will or inheritance, in those particular case, right, the cost of acquisition would be the cost of acquisition of the previous owner. That is what section 49 provides. But let us assume that I have received from an unrelated party. In that particular case, the amount which has been taxed to me under section 56 to clause 10, that would going to be my cost of acquisition. Let's say I have received a virtual digital asset. This would be a case when I am holding them as a capital asset. Let us deal with the situation that I am receiving or getting a virtual digital asset as a gift, but I am keeping it as an inventory. Certainly it would be taxable to me under section 56.2 clause 10 or section 28 clause 4. But in that particular case, they are going to be they're going to be valued as per section 145A and ICDS, and they provide that in those cases the cost would be nil. So when I'm transferring those particular VDA, I transfer a virtual digital asset which I have received as a gift from an unrelated party, from a related party, which are held as inventory, or you can also say that which have been received from an unrelated party. Let us say they are received from a related party, and I held them as inventory. So now they are going to be, now the cost of acquisition of the previous owner will not be a benefit, will be available to me. So now if I transfer them, the inventory, then I will be falling in the chapter of PGBP. Of course, transfer 115 BBH, that would be applicable. The question is not whether 115 BBH would be applicable or not. The question here is whether or what shall be the cost of acquisition. अगर ये कैपिटल असेट होता और रिलेटेड पार्टी से आया होता, तब तो एग्जम था, रिसीट पर टैक्स नहीं लगने वाला था मुझे, 56(2)(10) एप्लीकेबल नहीं होने वाला था मुझे. यहां पर तो हमने बात कर ली कि कॉस्ट ऑफ एक्विजिशन ऑफ द प्रीवियस ओनर वुड बी देयर. अच्छा, अनरिलेटेड पार्टी से आया होता तो हमने यहां पर भी डिस्कस कर लिया दैट इन दोस पर्टिकुलर केस द अमाउंट व्हिच वुड हैव बीन टैक्स टू मी अंडर 56(2)(10) वुड बी माय कॉस्ट ऑफ एक्विजिशन. पर अगर ये मेरे पास आया और मैंने इन्वेंटरी रखा हुआ है, तब 49(1) would not be applicable. In that particular case, I have to value them as per section 145A and as per ICDS 2, which deals with inventory. And here the cost at which I acquire is 0. The purchase price is 0, so the cost would be 0. Of course, when I am getting it as a gift और मैंने कुछ legal expenses करे हुए हैं मेरे नाम पे transfer करवाने के लिए, this would be a forming part of the cost of acquisition as per section 145A. So this may be added to the cost according to me. So this is how we dealt with this situation, that is section 56(2)(10). Once again, we have seen a situation, we have seen two circumstances where income is arising from virtual digital asset, and in those cases they are not going to be from transfer of virtual digital asset. Since they are not from transfer of virtual digital asset, section 115 BBH will not be applicable in those cases. The next issue is, can depreciation on VDA be claimed? Let's say now section 32 deals with the depreciation. Section 32 says that depreciation is allowed in respect of the tangible assets and intangible assets. What are the intangible assets which are eligible for depreciation? Copyright, patent, trademark, business or commercial rights of licenses, franchises, business or commercial right of a similar nature. Courts have held that commercial rights which are either akin to know-how, patent, copyright, trademark, license or franchises, or fall within the same genesis, they would be eligible for depreciation. But according to me, VDA is neither akin to them nor they fall within the same genesis. So according to me, there will not be any depreciation allowed on virtual digital assets. So if they are held as capital assets, I cannot claim any depreciation on the particular virtual digital assets. if they are held as inventory, there is no question of claiming any depreciation on because inventory are anyway not eligible for the purpose of depreciation. They are to be valued as per section 145A. So we have to take a cost or market value, whichever is less. That is what we have to do that, right? Now I'll come to mining in a little while. General rule is that, or let us discuss mining right now. Let us say I have got, I'm carrying out a mining. When I say mining, it means that I'm undertaking some necessary computer processes to solve computer equations, and I'm entitled to a mining reward of new tokens, right? So now when this mining is coming, I'm getting an income from mining that would also be taxable to me. Once again, when I transfer the non-fungible tokens or cryptocurrencies which I have got, even when I transfer, they are going to be taxable, and that taxability would be under 115 BBH. Now, there can be a situation when there is a transfer without consideration. We already dealt with the situation in the earlier sites. So, when I transfer a virtual digital asset to Mr. X, there will not be tax treatment in my hands because I am transferring without consideration and giving as a gift. But so far as the recipient is concerned, it will be taxable in the hands of the recipient, either under section 28 clause 4, it may be taxable under 56 2 clause 10, right? It would be taxable to him. And the related part, if it is received from a related party, not taxable. On account of marriage, not taxable. So if you are falling in 56 to 10, it would be taxable. If it is received from an unrelated party, then it is going to be taxable. And we have already dealt with this, so I'm not repeating it now. We have already covered this situation. Now, what if VDAs are lost or stolen? Now, cryptocurrencies can be lost. They can very well be lost if the key is misplaced, right? Or if the VDAs are acquired by way of inheritance, let's say, and the key is not transferred or key is not conveyed. In that case, VDAs can be lost. The question is that if the VDAs are lost, will this loss be allowed? Now, if we look at the decision of Vania Silk Mills versus CIT 1991, 59 Taxman 3 Supreme Court, they have held that there is no transfer when the asset is destroyed, as the asset has to exist in the process of transfer. So now when the VDAs are lost, it won't be regarded as transfer. When they are not regarded as transfer, there is no question that the loss would be allowed because there is no transfer. Anyway, section itself provides that no losses would be allowed. The losses are anyway controlled, but even if they are not controlled, then section 115 BBH will not come to the rescue. However, if the VDAs have been treated as stock in trade, then any loss to such an event should be allowed under section 29. Then section 29 would be applicable, and here it is not on account of transfer. So basically, when it is not on account of transfer, 115 BBH restrictions will not come, and it would be a business loss. It would be covered under section 29 if they are held as an inventory. Now, what is going to be the cost of acquisition in case of the VDA? Section 115 B at subsection 2 clause A provides that no deduction in respect of any expenditure other than cost of acquisition, if any. Now, please note that two words are important. They say that deduction will not be allowed in respect of any expenditure other than cost of acquisition, if any. The importance of the phrase if any, I'll come in a little while, but as of now, the only deduction will be allowed with respect to cost of acquisition. Any allowance or set off of any loss, right? So nothing would be allowed, only cost of acquisition. So I would be allowed deduction of only cost of acquisition. Now please note that here they have used the word cost of acquisition. The word cost is to be interpreted differently as compared to the word price. Gujarat High Court, Honorable Gujarat High Court had an occasion to deal with an issue in some matter, and it was held that the price is different and the cost is different. So any expenditure which is incurred to bring the goods to the present location, that needs to be added to the cost. So cost includes the direct expenditure. So price, yes, it would be allowed. Second, if I have paid a brokerage to acquire that particular VDA, that should also be forming a part of the cost. But please note that if I have paid some brokerage on transfer, it will not be considered as a part of the cost of acquisition and the brokerage paid on transfer. So when I'm selling it, when I'm transferring it, that brokerage will not be allowed as deduction. But if I have paid a brokerage or I have paid some legal fees to transfer those particular VDAs to my account when I'm buying it, it would be a direct expense, it would be allowed. Now the problem that would come over here is they say that no expenditure will be allowed as deduction. Now look at a situation. I am doing a business of trading in virtual digital assets as well as I am doing some other business. Now I have hired a person. This person is responsible for looking after my share transaction business as well as this person responsible for looking after my VD and he is being paid salary. So the salary and now expense would be allowed as deduction so far as the share transaction is concerned because there is no such restriction over there. However, the salary will not be allowed so far as the VDA is concerned. So I need to bifurcate that particular salary expense or other expenses. That could be a depreciation on my computer, that could be the electricity expense, that could be the rent of the premises. So all the expenditure are required to be bifurcated between the two businesses. How should I bifurcate the business? I may bifurcate the business based on the turnover or some other rationals. Ideal rational in my opinion would be based on turnover. We can bifurcate those particular expenditure and the expenditure which are attributable to the dealing in VDA, all those expenditure will not be allowed as deduction. Now, is indexation of the cost of acquisition allowed? We have already discussed that. On the perusal of section 115 BBH2, it appears that indexation of the cost of acquisition may not be allowed. This provision starts with a non-obstant clause and that will override all other provisions of that and including the second proviso to section 48 which provides for the indexation benefit, and indexation will not be allowed. But then this imposes restriction from financial year 20 to 23 onwards. So let's say I have sold some cryptocurrency in the financial year 21-22 or in the past and they are held as a capital asset, then in my opinion benefit of indexation is available. In my opinion benefit of indexation is available. One may claim the benefit of indexation over there. So even if they are sold in the past, so if I go back to the previous slide, then if they have been sold in the past, that is in the financial year 21-22 or in the earlier years, and they are classified under they are held as a capital asset, then even the brokerage which you have incurred on transfer, that would be allowed as deduction. Now it wouldn't be allowed, but then at that point of time 115 BBH was not there. So I am not falling under 115 BBH so far as financial year 21-22 or financial year 20-21 is concerned. So there it would be allowed. Indexation as well. If I was sold in those years, it would be allowed. If I am selling after introduction of section 115 BBH, to my mind, the benefit will not be available. Now, what is the relevance of the word if any after the words cost of acquisition? We have seen here cost of acquisition if any. Now, what is the word if any? What is the reason they have added the word if any? Now, we are aware that the virtual digital assets may be acquired by way of airdrop as well. Now, in those or they are acquired by way of slump sale. What would be a situation if they are acquired by way of airdrop of slump sale? It may be the case where the value of the virtual digital asset or the cost of the virtual digital assets, cost of acquisition we may not be in a position to determine the cost of the virtual capital asset. Now somebody may apply the judgment of BC Srinivasa Sethi, which says that when there is no cost or the cost cannot be determined, in that case there will not be a capital gain. So to avoid this circumstances, they have said that if any, so the benefit or the deduction would be available only with respect to cost of acquisition, if any. If there is no cost of acquisition or the cost of acquisition cannot be determined, you won't be falling in the case of BC Srinivasa Sethi now, and there would be a capital gain. In those cases, take the cost of acquisition as nil. So if you are acquired by airdrops, cost of acquisition is going to be nil, right? Now, benefit of maximum exemption limit, that is the another issue which we are planning to discuss. Now, please note that as I mentioned that section 115 BBH falls in chapter 12, and in those cases the benefit of maximum exemption limit would be available only categorically provided in those sections. Look at section 111A, it categorically provides the benefit. 112, it categorically provides the benefit. right? But if you look at section 115 BBH, it does not provide for the benefit of basic exemption limit, meaning thereby the advantage of basic exemption limit will not be available. So let us take a case that I have transferred a virtual digital asset. I have no other income. I have transferred a virtual digital asset and my income is 2 lakhs of rupees from transfer. It will be taxed at a flat rate of 30%, 60,000 rupees, right? So the 60,000 rupees would be taxed to me. Now, wait for a minute. The next issue that comes up is, can I claim the rebate under section 87A, which is available to a resident individual if the income does not exceed 5 lakhs of rupees? Then up to 12,500 rupees, the rebate. Can I take the advantage of that rebate? Can I say 60,000 minus 12,500 and it is now 47,500 plus education says 4%? Can I do that? Benefit of rebate is denied if it is categorically provided so. So look at the difference. Benefit of maximum exemption limit would be allowed only if it is categorically provided. That is not provided here. So we will not give the benefit of basic exemption limit. Rebate under section 87A would be allowed or would be denied if it is categorically provided. So now 112A categorically denies. Section 112A categorically denies that benefit of rebate is not allowed. But then there is no such categorical denial over here. So the benefit of rebate under section 87A would be allowed so far as income arising from transfer of VDA, which is taxable under section 115 BBH is concerned. So benefit of basic exemption limit will not be allowed, but then the rebate under section 87A would definitely be allowed. Can deduction under chapter 6A be claimed? The answer is no, because they have categorically mentioned that there is no deduction, allowance or set-off would be allowed. So no deduction under chapter 6A would be allowed. Meaning thereby, if I quickly summarize, basic exemption limit advantage in respect of income arising from transfer under section 115 BBH is concerned, not allowed. Rebate under section 87A allowed. Deduction shall not be allowed if income is computed under section 115 BBH. But mind it, if income is from lending of virtual digital asset, or let's say the income is coming to me and by way of a gift is not a transfer and then it is taxable, then in those cases 115 BBH is not applicable. So in those cases, those income will shift to basic exemption limit. Those income will be eligible for deduction. 87A rebate would anyway be available, because if it is available for 115 BBH, then for other income it is anyway available. So the restriction from deduction under chapter 6A, that is 80C to 80U, would be there only if it is covered under chapter, that is only if it is offered to tax under section 115 BBH. Right? Denial of advantage of basic exemption limit would be only if it is covered under 115 BBH. Otherwise, there is no denial, right? Now, treatment of loss. Now, the question here is that now you are denying a loss. So, loss from both the ends denied. If I have sold Bitcoin, I had a loss. I had sold Bitcoin, another transaction, I had a gain. Loss will not be allowed to be set off. I had loss from sale of Ethereum, gain on sale of Bitcoin. Loss will not be allowed to be set off. Whatever loss, I had some other source. I had a loss from a business. Even that business loss, normal business loss, cannot be set off here. I have a loss in sale of Bitcoin. That loss cannot be set off with the other business income. So this loss from all the corners denied. The question here is, I had a loss in the last year. Can the loss which I had in the last year, will that particular loss be set off against the business income? I had a loss in financial year 21-22. See, this would be a case from 20 to 23 onwards. This would be a case when the income is offered to tax under 115 BBH. 115 BBH was not there in the last year. Can there be taxed? Now please note that we have a judgment of Shah Siddiqui, and if we apply the judgment of Shah Siddiqui, then the ratio that emerges is the assessee should have an absolute right to carry forward and set off of the losses incurred on or before the assessment year 20 to 23. However, such losses shall not be allowed to be set off against income taxable under section 115 BBH. Such right can be exercised within the four corners of the provisions specified in section 72, 73, section 74 and section 80. What do they provide? They say that they say that the withdrawal of rights are they say that whatever rights are expressly saved by the savings provision they stand saved. So whatever rights which are expressly saved by the saving provisions, they are stated saved, they would be saved. But what about the rights which are not been expressly saved? That is what the issue is. They say that, but that does not mean that the rights that are not saved by the savings provision are extinguished or stand ipso facto terminated by the mere fact that a new statute repealing the old statute is enacted. Rights that have accrued are saved unless they are taken away expressly. This is what the judgment of Shah Siddiqui provides. The important paragraph is this which we have read. I repeat, whatever rights are expressly saved by the saving provisions stand saved, but that does not mean that rights that are not saved by the saving provision are extinguished or stand ipso facto terminated by mere fact that a new statute repealing the old statute is enacted. Precisely it means that सेक्शन 115 बीबीएच में ये कहीं नहीं कहा कि पुराना जो लॉस है वो भी चला जाएगा. अब क्योंकि ये नहीं कहा हुआ है कि पुराना लॉस भी चला जाएगा, इट्स मींस दैट जो लास्ट ईयर में मेरा लॉस था वो कंटिन्यू रहेगा. हाँ, वो लॉस करंट ईयर की इनकम के साथ, करंट ईयर की बिटकॉइन की इनकम के साथ एडजस्ट नहीं होगा. वो करंट ईयर की इनकम के बिटकॉइन की इनकम के साथ मेरा एडजस्ट नहीं होगा. लेकिन लास्ट ईयर मेरा लॉस था और मैंने लास्ट ईयर कोई बिजनेस इनकम के सामने सेट ऑफ, बिजनेस लॉस था बिजनेस इनकम के सामने सेट ऑफ कर लिया, या लास्ट ईयर मेरा शॉर्ट टर्म कैपिटल लॉस था और मैंने लॉन्ग टर्म कैपिटल गेन के सामने वो सेट ऑफ कैरी फॉरवर्ड के चैप्टर के हिसाब से मैंने सेट ऑफ कर लिया, या then there will not be a question. Restriction is from this year, not from the earlier year. Now let us deal with one practical example. Let us say this gentleman is an assessee is an individual. Let us look at this. Here we can see that there are trading income from Bitcoin. He has a loss 10 lakh. We are aware that you have a loss in the financial year 22-23. So this loss will not be allowed to be set off. From sale of Bitcoin, 1 lakh taxable. From sale of new fungible token, 2 lakh taxable. I'm talking about case number 1. We are restricting ourselves to case number 1 where we have 10 lakh of rupees as income from trading, which is a loss, so the loss will not be adjusted with this 3 lakhs. And the last is Bitcoin received as a gift from friend where the FMV is 1 lakh, total is now 4 lakhs of rupees. My total income is 4 lakh. The last category, Bitcoin received as a gift, 1 lakh, it is not on account of transfer, so it will not fall under 115 BBH. That 1 lakh would go to basic exemption limit. Out of this 4 lakh, 1 lakh would go to a basic exemption limit. The other 3 lakhs of rupees would not go to a basic. I mean, I have a space in basic exemption limit 1,50,000 because out of 4 lakh I have shifted only 1 lakh to basic exemption limit, because this 1 lakh, the income received or the Bitcoin received as a gift from a friend, 1 lakh. Now from a friend is not a relative, so this 1 lakh is going to be taxed. This 1 lakh is not, that is not income arising from transfer, but it is a taxable under 56(2)(10). So in that particular case, they are going to be taxed under normal provisions. It will enjoy the benefit of basic exemption limit. It will go to basic exemption limit. So on this 1 lakh, no tax. The other two income, 1 lakh and 2 lakh, which is from sale of Bitcoin or from the sale of the new non-fungible token, 2 lakh, thus total 3 lakh would be taxed. They will be taxed at 30%, so 90,000 rupees. Rebate would be allowed, as we discussed, 12,500. Net tax liability 77,500, and there is a rebate. Please note that I have not adjusted this 3 lakh, the 10 lakh loss in your 3 lakhs of rupees with the profit of 3 lakh. The loss has gone. It is a dead loss. This loss will not be allowed to be set off. We are talking, this all is for financial year 22-23 onwards. Case 2, once again I have a loss 10 lakh. You are not going to set off. From sale of Bitcoin loss 1 lakh won't be set off, forget it. From sale of non-fungible token income 9 lakh, that will be taxed. Income from received as a gift 1 lakh, so my total income is 10 lakh. 1 lakh would go to basic exemption limit. Remaining 9 lakh will be taxed at the rate of 30%, 2 lakh 70,000 rupees. Since the income exceeds 5 lakhs of rupees, the rebate under section 87A will not be there. I would be liable for a education says 10,800. I have a tax liability. Let us go with the case number 3. Here I have income from trading 10 lakh. It is classified under PGBP. From sale of Bitcoin 11 lakh, 1 lakh, 11 lakh. From sale of non-fungible token I have a loss. Nothing doing with the loss. My income is 11 lakh and a gift 1 lakh, total 20 lakh. Only gift will go to basic exemption limit, that is 1 lakh. 11 lakh will be taxed at the rate of 30%, that will be 3 lakh 30,000 rupees. Right, 3 lakh 30,000 will be taxed. Of course, there will not be a rebate under section 87A because my income is 12 lakh, which is more than 5 lakhs. So that there is no question of rebate. It will be taxed at 3 lakh 43,200, including education cess. Last one, I have got all income, total 16 lakhs. Only 1 lakh would shift to basic exemption limit. Rest 15 lakh will be taxed at 30%, 4 lakh 50,000 rupees, and it would attract education cess at the rate of 4%. Finally, I have this tax liability. So we have discussed all issues relating to tax treatment on virtual digital assets. The TDS part is yet to be discussed. I will come up with a separate video on this. I'm sorry this video turned out to be a little longer one, and that is the reason I take the TDS part separate. I'll come up with the TDS video in a short while from now. I hope this video would be of some advantage to you. If you have any other suggestions, if you have any other queries, feel free to share with me. Whatever your suggestions that would be, I will incorporate all your suggestions. I will try my level best to incorporate all your suggestions. Please note that all the views that I have expressed here, they are my personal views. Before you execute a transaction or you file your return or go ahead with a tax treatment, please take advice of your concerned tax expert. I really enjoy putting these videos on YouTube. I'm sure this video would be of some benefit. Thank you very much. We'll see you in the next video. Until that time, please take good care of yourself. Thank you very much. Thank you very much.